Hello, my name is Joe Adelisi. This presentation is entitled How to Pay Yourself a Tax-Free Income at Retirement. This is a program that I actually developed for lawyers that have to do mandatory continuing education, but we're posting it on our website because it's just as important for people to view it and look at it and help them prepare for retirement and understand different strategies and options that they have. So in a nutshell, the short version of what this presentation is going to be about today is this. If you deposit $5 in a retirement account and over the years that $5 grows on a tax-deferred basis and becomes $10, and over years it continues to grow and the $10 becomes $20, and then in retirement it's at a point where you're going to take distributions from that $20 in retirement, this is where you have to ask yourself this question. At what time do you want to pay the taxes on that money? Do you want to pay taxes on the $5 contribution, or do you want to pay taxes on the $20 distribution at retirement? And if you've answered that you'd like to pay tax on the $5 contribution, then that's good. Sit tight and pay attention to this presentation because that's what this is all about. However, I have to tell you that your 401k or your IRA account is designed so that you're going to pay tax on that $20 distribution. So let's learn why. Have you ever considered what the definition is of saving versus investing? Saving is putting your money somewhere that when you need it, it will absolutely be there and will be available for you. It's money that you absolutely do not want to lose. It's money that you absolutely know for sure will be there when you need it. Investing, on the other hand, is putting money somewhere, hoping that something good will come of it when you need it. It might be there, you might have lost some of it, you might have lost all of it. Basically, this is money you can afford to lose. You are taking a risk with that money with the expectation of making a gain, but you have no guarantee at all. You hope it will make a gain. So when it comes to saving for retirement, you have to ask yourself, am I saving or am I investing? Now you can save for retirement in a 401k or a TSA or an IRA. And you can temporarily defer the taxes by doing that. When you retire, however, you're going to have to pay taxes on all of that money and on all of the income that it generates. Going back to the example at the beginning, the $5, $10, $20, typical 401k, IRA, TSA account, you're going to pay tax on the full boat, the $20, when you take it in distribution. This is an example of the U.S. Debt Clock website, usdebtclock.org. And if you've ever gone onto that website, you'll see that the national debt, and there's a whole bunch of numbers that are going to be constantly changing and in motion. And when we did this presentation, the national debt was a little over $21 trillion. Now that $21 trillion debt, national debt, has to be retired at some point. That debt has to be paid by the U.S. government. And where does the government get its money to pay its bills? Well, from taxes. So if we've got a $21 trillion debt and rising, what do you think is going to happen with tax rates? Tax rates in retirement will almost certainly be higher because typically retirees have fewer deductions. Think about it. Your house is paid off or almost paid off, so you don't have mortgage interest deduction. You're not working anymore, you're retired, so you're not making contributions to 401ks or IRAs to have tax deferrals there. Typically, you're an empty nester, your kids are grown, so you don't have the child care tax credit. So as a result, what do you think happens? Retirees in retirement are almost certain to have higher taxes. And taxes, as we saw from the national debt, are almost certain to increase. In 2012, the top tax rate was 34%. It raised to 39% in 2013. And believe it or not, back in 1979, the top tax rate was 70%. Tax rates are almost guaranteed to go up. The math mandates it. So here's an example of what the top marginal tax rates were from 1913 to 2018. And as you can see, during World War I, tax rates were hovering around 80%. During World War II, the top tax rate was in the high 90% range. And as I said, during the late 70s, early 80s, tax rates 70%. And it was only during the Reagan era that tax rates came down to really the low rates that they are now. Over all this period of time, the average tax rate would be almost 58%. So you have to ask yourself, how would you feel about paying at a federal rate 58% on your income? Not a pleasant prospect, but the math, as I said, requires it if we're really going to service our national debt. So which makes more sense? Tax-deductible deposits before retirement or tax-free income during retirement? And the reason I have an asterisk at tax-deductible deposits before retirement is if you're lucky enough to have an employer who provides you with a 401k account and your employer happens to give you a match of some employers 3%, some 6%, and it varies. So if you're lucky enough to have an employer who has a 401k and they actually do a match, that's free money that you can take. So in that case, tax-deductible deposits before retirement absolutely makes sense because free money is free and nothing is ever going to beat free. However, if you're positioning money over and above the match, there may be better ways for you to put that money to work for you so that you can actually generate tax-free income during retirement. So let's take a look at a typical traditional IRA. And these numbers, I've used round numbers and made a lot of generalities so this hypothetical is easy to follow. But if you take a husband and wife depositing $6,000 a year, and if they're in the 33 1/3% tax bracket, they're getting a tax deduction of $2,000. And if they're doing this consistently over 20 years, $2,000 a year saved over 20 years, they've saved a total of $40,000 in taxes. And if their retirement account does phenomenally well, and they've got $1 million in that IRA or 401k at the time they retire, and they want to now withdraw money, say about $75,000 a year, that's about 7.5% of the account, they would have to pay $25,000 in taxes because of that $75,000 withdrawal, and they actually net $50,000. Okay? So let's take a look at how this actually plays out over time. You have to ask yourself, for whose retirement did I just save? Now remember, after 2 years of paying $25,000, you're paying $50,000 in taxes to the U.S. government. After 20 years of savings, the $2,000 a year that you saved in taxes, that $40,000 gets eaten up. The government got back not only their $40,000, but an extra $10,000 just in year 2. So after the second year, the government has recouped all of the 20 years of tax deferral and actually is ahead of you now by $10,000. So you have to ask yourself, whose retirement am I saving for? Mine or the government's? So how much would you need to draw to actually net $75,000 in retirement? So if we assume the same facts, a person who desires to net $75,000 must actually draw about $112,000. This would probably deplete the $1 million account balance and not support the person for the rest of their lifetime. Not a happy prospect in retirement. I always ask my clients, do you know how your IRA or 401k works from a tax perspective? So again, take the typical couple who gets Social Security income. Husband gets about $2,500 a month, wife gets about $1,400 a month. That's about $3,900 a month. And if they're a couple here in Southern California who live on maybe $150,000 a year in annual income and they want to duplicate that in retirement, they now have to draw out from their 401k or IRA another $8,000, which will give them about $11,900 a month in retirement. Well, guess what? In order to do that, once they draw that $8,000 out of their 401k or IRA, they have to pay tax on that. So they'll have to take another monthly withdrawal to pay tax on that $8,000, and that's going to be about another $1,600. When they draw that $1,600 out of their IRA or 401k, they're also going to have to draw out another $320 to pay tax on that tax. And guess what? This is going to push their Social Security up into the taxable bracket. So now they're going to have to draw out $680 to pay tax on their Social Security. And when they draw that $680 out, they're going to have to draw out another $136 to pay tax on the $680 withdrawal. Does this sound insane? It is. They're going to have to draw out an additional $2,736 just to pay tax on their withdrawal. Did anyone ever explain to you how these accounts work from a tax perspective. When most of my clients hear this, their eyes become the size of silver dollars. They never had any idea. So the question is, how can you withdraw your money from your retirement account tax-free? And believe it or not, the government wants to encourage us to become financially independent without dependence on Social Security. Therefore, government provides us with various provisions or incentives within the tax code to help us do just that. Internal Revenue Code Section 7702 is one such provision. This section of the tax code allows insurance companies to structure qualified insurance policies with unique tax advantages. Let me go over that again. This section of the tax code allows insurance companies to structure qualified insurance policies with unique tax advantages. And what that means is these policies can credit interest earnings on your deposits without taxation, tax-deferred accumulation, just like an IRA, just like a 401k. But these policies can also allow you to borrow the money out of your policy without tax, and you can pay off these tax-free loans with the tax-free proceeds from the policy's death benefit without ever paying taxes on any of the money. There's a unique combination of three benefits that these structured qualified insurance policies are allowed to provide. They are the tax-free death benefit that an insurance policy provides, the tax-deferred cash accumulation or tax-deferred growth inside an insurance policy, just like a 401k or IRA, and tax-free loans that you can take or withdrawals from an insurance policy that do not count as income. The U.S. Treasury Department lists life insurance cash values as one of the top 10 tax subsidies available to us. It gets even better. There's a thing called Indexed Universal Life. Now, you can link your interest earnings on the cash inside of your insurance policy to an equities index. So without taxation, without buying or selling any stocks, without risk of losing any of your money in the market, you can safely put your money into an indexed policy. So how does an indexed insurance policy work? With an indexed policy, there is no direct participation in the equities market. The policy simply credits your account with interest that is earned as a result of a movement of an index, a specific index such as the S&P 500, the NASDAQ, or the Dow Jones Industrial Average. So for instance, if the S&P goes up 10%, certain policies are structured that they capture that 10% increase in the market, credit that to your insurance policy, and once it's credited to your insurance policy, it can't be lost. So how does the interest crediting actually work? When the index is positive, your account is credited with a percentage of the gain. Policies vary. Some policies have a 10% cap, some have a 12% cap, some have a 16% cap, which means if the S&P 500 goes up 16% and you have a policy that's capped at 16%, you have captured the entire 16%. If the market goes up 16% and you have a policy that's capped at 10%, you capture only the 10%. Everything over the 10% is captured by the insurance company. When the index is negative, however, none of your losses are ever deducted from your account. It just stays the same. And the reason I've got an asterisk there is there's a small obvious charge for the insurance, but since this is an insurance policy, it does credit a small guaranteed interest rate. So what's the result of all this? The result is that you get an interest rate credited to your account that only tracks the positive gains. It does not track the losses. And once interest is credited to your account, it can't be lost, and further interest is compounded. So what do? You get tax-free, compound interest earnings, interest crediting linked to an equities market index, and you get tax-free income withdrawals or loans during retirement. So the tax-free death benefit. Death benefit is the main reason you should buy life insurance. And sometimes people will say, well, I really don't have an insurance need. If you're saving for retirement, you have an insurance need. Obviously, if you have people that will be left behind, there's an insurance need. If you deposit, say, $19,000 or $20,000 in your 401k account, and God forbid something happens to you, what does your family get? They get the $19,000 or $20,000 that's in your 401k or IRA. However, if you have a structured qualified insurance policy that you're depositing that same $19,000 or $20,000 in, and something happens to you, God forbid, well, guess what? Since there's a death benefit associated with this insurance policy, your family is going to get whatever that death benefit is, and that depends on your age, obviously, and your sex. But generally, these policies will carry $300,000, $400,000, $500,000 death benefit. So how is your family better off with the $20,000 401k disbursement, or perhaps $300,000, $400,000, $500,000 death benefit payout? Obviously, the death benefit provides a great advantage. These policies can also be used for income replacement, to pay your mortgage, to pay debts, supplemental funding of college costs, business succession planning. The money in these policies is available penalty-free, unlike a 401k or an IRA, for any reason. You also get tax-deferred accumulation. Just like an IRA or 401k, your policy's cash value has the potential to grow income tax deferred based on positive changes in an external market index, and more importantly, it's guaranteed to never decrease due to market volatility. You also get tax-free distributions. Your loans or withdrawals from your policy's cash value are income tax-free. So these distributions, again, can be used for anything you choose, whether it's your supplemental retirement, long-term care needs, to pay off financial debts, to pay for a wedding, to pay for college tuition, to even go on a vacation. The tax code provisions that allow all of these benefits in these insurance policies are Internal Revenue Code Section 101, which basically says that a life insurance death benefit is received federal income tax free. Internal Revenue Code Section 7702 is the section that defines life insurance and allows for it to grow tax deferred, just like a 401k or an IRA. And Internal Revenue Code Section 72E is the provision that said that loans taken from a policy are not considered distributions and are not includable in your taxable income. So, 7702, everyone should take advantage of Section 7702. You can use it for inherited money, cash settlements, bonuses, significant increase in income due to a raise, bonuses. Consider using a 7702 plan for any of these retirement savings. Last word, these plans are complicated to structure so that they're fully compliant with Section 7702. Before you put money in a Section 7702 plan, you should seek the advice of a knowledgeable consultant. And we're here to consult with you to do either your own plan or to help you with clients that you want to do this for. But just to give you an idea, if you're depositing $20,000 in a 401k and your employer doesn't do a match and you decide, well, I want to explore another strategy and possibly reposition that money. If you go to an insurance agent with this idea and say, I've watched this video, I understand that 7702 allows insurance companies to offer qualified insurance policies for this person. A life insurance salesman is just that. He's a salesman. He's going to design a policy. When he hears you have $20,000 to commit to a policy, he's going to say, okay, what's the most amount of insurance I can get for this person that he can afford to buy a policy? And it may be, for $20,000 you can buy $1 million of life insurance. However, when you come to us to structure one of these, we do it a little bit differently. We say, okay, if it's $20,000 that you want to accommodate, we go back to the insurance actuaries and say, I have, for instance, a 45-year-old male. He wants to put $20,000 a year into a qualified insurance policy to use it for supplemental retirement income. What is the least amount of insurance we have to buy to make this plan compliant? And they'll come back to me and say, well, okay, for this person, maybe we can only have a $400,000 insurance policy. That's the least amount of insurance you have to buy to make this compliant. And the premium, the actual premium, may be $10,000. And what we're going to do is we're going to actually deposit $20,000 into this policy, so that excess that we're depositing, we're actually overfunding the policy, and it's that excess that's going to be earning the interest in the index tied to the stock market index that's going to help this policy accumulate a lot more than a simple insurance policy would do. And as a result, you're going to be able to build up the tax-free income inside of an insurance policy in the same fashion that you would a 401k or IRA, but it will be designed completely different. So, going back to the caveat, you really need to consult with a knowledgeable person who understands what the ins and outs of these policies are. Okay, so moving on, if you have any questions, there's my email address on the screen. Feel free to email me. I'm happy to answer questions. There's our toll-free number if you want to call. And again, my name is Joe Adelisi. Hopefully this presentation has been informative to you. Thank you.